This is an analysis from Alpha Business Media.
If you wanted to invest in the Himalayas, specifically Nepal, for decades, your biggest obstacle wasn't really the market or even the logistics. It was a calendar. The whole story of foreign investment was just defined by this bureaucratic inertia, this invisible time cost. You had to go through a physical manual gauntlet at the Department of Industries.
And we're not talking about a few weeks.
No, we're talking 6 months, sometimes well over a year, just for that initial green light.
It was a system that, it maximized friction. It was built for exhaustive, sequential human review. And that really only rewarded the most patient investors.
Or the most connected ones.
Or the most connected. That endurance factor was, it was the single biggest hidden cost of doing business there. But that's the critical shift we need to talk about. As of late 2025, that whole paradigm is, well, it's been fractured.
Right. We're now seeing the launch of Nepal's new automated FDI approval system. They're calling it the automatic route. And the promise is an approval timeline of 7 calendar days.
7 days. Think about that.
From an average of 6 months down to 1 week. It's a staggering change.
It fundamentally re-architects the entire Himalayan investment landscape. I don't think it's an exaggeration to say this is the single most significant process re-engineering they've done since the economic liberalization back in the 1990s.
So the door isn't just open, it's been completely digitized.
Exactly.
And streamlined.
So what does this mean for you, the investor, right now? The core tension, it's completely flipped. It's no longer a question of if Nepal is open for business.
No, that question's been answered.
The question is, how do you successfully navigate this new, very sophisticated digital pathway, a pathway that, as we'll see, demands absolute precision?
Administrative precision.
So our mission in this deep dive is to dissect exactly what this new system is checking, who gets to use this fast track, and crucially pinpoint the subtle documentation errors that have basically become the new gatekeepers.
They're the new friction points. Okay, so we have this promise of 7 days. It sounds incredible. But to really get the scale of this reform, we have to look back at that 180-day legacy it's replacing. What made the old DOI process such a time sink?
Well, the old system was a classic sequential process. It was entirely based on paper. So imagine printing out a multi-100-page dossier.
Wow.
We've got your Foreign Investment and Technology Transfer Act application, detailed project reports, complex financials, and you physically submit that stack of paper to the Department of Industries.
And that's when the clock starts ticking, very, very slowly. That stack of paper immediately kicks off a multi-stage waiting game.
Precisely. First, the DOI does its own internal review. That's manual, often takes a month, and it almost always comes back with a long list of questions for the applicant.
Okay, so that's stage 1.
Right. Once you've satisfied them, the file moves in sequence. If your project is over a certain size, it has to go to the Industrial and Investment Promotion Board, the IIPB.
Which is chaired by the minister.
Chaired by the minister, which means you're now dependent on scheduling a board meeting. That adds huge delays right there.
And it wasn't just the DOI, was it? The file had to do the rounds across the whole government.
Exactly. It would be routed to the relevant line ministry, say the Ministry of Power for a hydro project, then to the Ministry of Finance for revenue assessment, and critically, to the Nepal Rashtra Bank.
The central bank. The NRB.
Yes, the NRB, to check capital inflow, verify the source of funds, do basic AML checks, and any single query from any one of those bodies could add weeks of delay. Sometimes it would send the file all the way back to the beginning.
That's where the 180 days comes from, all that friction.
That's the friction.
So let's flip the script. How does this automatic route achieve such a radical compression? What's the mechanism? It can't be sacrificing due diligence, can it?
No, it just completely inverts the model. It moves from that sequential one-by-one processing to parallel algorithm-driven verification. The new investment portal is the conductor. It kicks off several key checks at the exact same time the moment you hit submit. Okay,
so instead of one ministry waiting for another to sign off, the system is just doing real-time cross-references in the background. What databases is it talking to?
The checks are really detailed and unforgiving. It cross-references your local partner's PAN and VAT registration with the Inland Revenue Department instantly.
So it's checking for any outstanding tax liabilities.
It's immediately. It also verifies your company registration documents with the Office of the Company Registrar. And, this is critical, it runs the foreign investor and the funding entity against both national and international AML and counterterrorism financing watch lists.
That is sophisticated. But you mentioned an internal check as well. What about the business plan itself? How can an algorithm check if a project is, serious?
That's probably the most interesting part. It's an internal coherence check. The algorithm cross-references your financial projections, your revenue targets, your scale of operations against the capital you've actually committed.
So it's looking for inconsistency.
Glaring inconsistencies, yes. If the numbers just don't add up, or if the committed capital is ridiculously small for the ambition you've outlined, it triggers a red flag.
And that shunts the application out of the fast track.
Immediately. But if no flags are raised on any of these parallel checks, the digitally signed approval letter is auto-generated and issued on or before day 7.
We have to stress this point, though, this crucial distinction. That 7-day approval, it's the gateway. It's permission to bring your capital in. It is absolutely not the destination.
That is the essential insight for any investor listening.
The bottleneck hasn't been eliminated. It has just been very successfully shifted.
That's it. The central government solved the problem of the initial permit, but that permit is not your license to operate. It's not a construction permit, and it is certainly not your final environmental clearance or your land title.
So all that process friction has just moved.
It's moved from the central level down to the subnational level. It's now sitting squarely in the municipal permit offices, the provincial land registries, and the utility connection queues. That's where the real work for the investor now begins.
Okay, so this brings us to who actually gets to use this fast track.
Right. And the list of eligible sectors, it's not a random grab bag. It's a very meticulously curated policy statement. It really reflects Nepal's strategy to leverage its competitive advantages and move up the value chain.
Looking at the list, it's clear they're targeting investments that are scalable, asset-light, things that don't immediately strain the existing and, let's be honest, often fragile infrastructure. So who gets this access?
The number one priority is unambiguous: information technology and business process outsourcing, BPO.
Which makes perfect sense from a policy view. IT services are the gold standard for asset-light investment. High export revenue potential, high-value jobs per dollar invested.
Minimal land or environmental impact.
Right.
By putting IT on the 7-day route, Nepal is basically sending up a flare to global tech firms. They're signaling that they are serious about competing with hubs like India or the Philippines.
They're saying, we can make your decision in a week, not a year.
Exactly. The speed itself is the incentive. It's designed to capture that fast-moving tech capital that won't wait around.
Okay, what's the second strategic area?
High-value agriculture and processing. And this is a very deliberate move away from just subsistence farming.
This is about value add.
It's all about value addition and vertical integration. So we're seeing a focus on things like controlled environment, horticulture, modern greenhouses, and the processing of medicinal and aromatic plants into high-margin essential oils.
So they're trying to capture more of the final retail price, exporting finished goods, not just raw crops.
Precisely. And the third category is specific tourism infrastructure, but it's very constrained.
Right. They're not just opening the floodgates for massive resorts here, are they?
Not at all. It's limited to projects with smaller footprints and predictable environmental impacts. So think boutique hotels, eco-lodges, cable car systems, adventure sports operations like ziplining.
So high-yield, low-volume tourism.
That's the goal. They are deliberately avoiding the huge land acquisition and social impact headaches that come with those sprawling large-scale complexes.
Which brings us to the sectors they've deliberately kept on the slow path. What kind of projects are still stuck in that 180-day queue, and why?
Large-scale hydropower, so anything above 100 megawatts. Heavy industries like cement and steel manufacturing, and mining.
And the rationale is pretty clear.
The sources make it explicit. These projects involve incredibly complex land acquisition, massive environmental and social impact assessments, and huge national resource decisions. These are things you just can't trust to a 7-day algorithm. The risk is too high. They demand that detailed, human, interministerial review.
Okay, this is where we get to the really granular level. The part that separates a successful, fast-tracked application from one that gets instantly kicked into that multi-month manual review.
Right.
Speed demands flawless execution. It sounds like documentation precision is the new competitive advantage.
That is the reality.
Right.
We've looked at the early feedback, and 3 big documentation pitfalls keep coming up. They're the most common reasons the algorithm flags an application and boots it back to the DOI.
Let's break them down. The first one, mismatched financials and the business plan narrative. This sounds technical, but it really speaks to how serious the investor is perceived to be.
It's the algorithm's sanity check. Let's say you upload a business plan projecting rapid scaling. You're targeting $5 million in revenue by year 3, something like that. But your committed initial capital declaration only shows, say, $150,000 for CapEx. The algorithm immediately compares that ambition against the pledged resources.
So the system just assumes that either the plan is completely unrealistic or the investor is trying to set up a shell operation.
Exactly. It flags it as either undercapitalized or just not serious. Your financial model has to be rigorously consistent. It has to show transparently how that committed capital is going to credibly get you to those revenue targets. Any inconsistency, no matter how subtle, will trigger a human review, and that can take months.
Okay, pitfall number 2. This one deals with global compliance. Ambiguous source of funds declaration, the SOIF. This has to be non-negotiable given the international pressure on FATF compliance.
Absolutely non-negotiable.
Yeah.
And the system demands a completely auditable legal trail. A simple bank statement is not enough.
So what does it require?
It requires a formal, notarized declaration from the investing entity's home country, usually with a supporting letter from their bank, confirming the legitimacy of the funds and their compliance with that country's own anti-money laundering laws.
And if the money is flowing through, say, a holding company or a special purpose vehicle, the paper trail can't stop there.
No, absolutely not. The trail has to be meticulously traced all the way back to the ultimate beneficial owners, the UBOs. If there is any ambiguity at all, a missing signature, a vague description like accumulated retained earnings without the audited financials to back it up.
Any break in the chain.
Any break in the ownership chain, the system flags it. And it goes straight to the Nepal Rastra Bank for a forensic manual review, which adds very significant delays.
And the third pitfall, incomplete local partner due diligence. This is so critical for joint ventures.
It really is. Foreign investors often just assume their local partner's administrative house is in order.
A dangerous assumption.
A very dangerous assumption. The problem is, this automated system is cross-referencing the local partner's PAN number with real-time data from the Inland Revenue Department. The foreign investor is held accountable for their partner's compliance.
And what triggers a red flag here? Does it have to be something major?
Not at all. It can be a minor outstanding tax liability, or even just a failure by the local company to file their annual returns on time. That will cause the system to flag the entire joint venture application as high risk.
So the lesson is crystal clear.
Paramount. Commission a full administrative and tax audit of your prospective local partner before you even think about uploading that application. Assuming they're compliant is the fastest way to derail your fast-track investment.
So the successful automation of this front end, let's call it phase 1, it's achieved its goal. It's accelerated that initial approval.
It has. But in doing so, it has shown a very harsh spotlight on all the back-end implementation issues. And that is the new strategic reality for investors.
Right. So by solving the big DOI problem, the central government has basically exposed the depth of all the procedural problems at the provincial and municipal levels. The focus just shifts.
It shifts from the central office in Kathmandu to the local land title office, the municipal construction permit desk, the utility connection queue. That's the new battlefield.
And that exposure, it creates what you've called a two-speed investment environment.
Yes, a very pronounced two-speed environment. The asset-light sectors, IT and BPO, they need minimal land, minimal utility hookups. They're poised to thrive. They can actually realize that 7-day promise right through to launch.
But the physical asset projects.
A new agri-processing plant, a boutique hotel. They'll find their central approval was fast. But the on-the-ground reality is still fraught with all the familiar frictions of subnational bureaucracy.
So if the central government just rests on its laurels after this phase 1 success, what does the base case scenario look like?
In the base case, the government's headline approval numbers will shoot up. It's a political win. But the rates of actual capital disbursement and project completion will lag way behind.
And that gap, that widens the definition of implementation risk.
For the investor, yes. Sophisticated investors will just have to allocate substantial resources, time, and money to local teams whose only job is to navigate that post-approval maze. You're effectively paying a premium to solve local bureaucracy manually.
But there is a more ambitious path, a best-case scenario. Phase 2. What would that radical integration actually look like?
The best case is the government initiating a radical project to integrate all those provincial and local digital systems into the central FDI portal, a true single-window system.
So you mean one application for the FDI permit, the local land registration, and the building permit, all processed at the same time.
Concurrently, through one portal, yes.
That would require immense political capital, wouldn't it? I mean, forcing all these disparate, sometimes autonomous local bureaucracies to align with the central system is something even regional giants have struggled with.
Absolutely. It means overcoming entrenched local resistance. It means forcing the digitization of core local records like land titles, which are often still on paper. But if they could pull off that integration, it would transform Nepal into one of the most operationally attractive investment destinations in South Asia.
This has been a fascinating look at how technology is really accelerating that investment gateway into Nepal. The core takeaway, it seems, isn't just about speed. It's realizing that the true cost of FDI now is not the time spent waiting, but the capital you have to deploy for that local post-approval navigation.
The technology is brilliant, but it can't solve those deep-seated systemic issues. It can't fix political instability or judicial delays. Success now depends on a dual strategy. You have to master the digital precision for the automatic route, but you also have to cultivate that old-school resilience and local intelligence to navigate the analog world that follows.
So as you look at this model of central reform, consider this final thought. If Nepal's automatic route is phase one and the ultimate goal is a true single-window system where central and local processes are seamlessly integrated, phase two, which country in South Asia, whether it's Nepal or one of its neighbors, will be the first to successfully force that interoperability and achieve a truly seamless investment experience from start to finish?